It was the economist Benjamin Graham, who basically is the father of value investing, who said that in the short run, the stock market is a voting machine, and in the long run, it is a weighing machine. But where options are concerned, more than 70% of them expire in less than 90 days. So for options traders, it's really the short run that matters, and that's why we're going to be talking to Carter Worth today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. I'm very pleased to be joined today by my good friend and longtime colleague from CNBC, Carter Worth. How are you, sir?
Very good. How are you, sir? Thanks for having me, of course.
Yeah. You know, most people think of you primarily maybe as the preeminent chartist in the world. Charts matter a lot. These are things that I talk about on this podcast, on every one of them, actually, because when it comes to options, folks will know that I'm kind of a deep dive, fundamental, sort of value-based investor at heart. But where options are concerned, we're really concerned about the price action. We're concerned about how the prices of securities move in the short term. Even options traders themselves price options based on how much they move, not on fundamentals at all. So when we think about volatility, we're thinking about the magnitude of movement. But where a chartist can come in is to talk both about magnitude and direction. So I was hoping maybe before we begin to take some questions, you could sort of give a background, if you will, on your sort of philosophy about things and how you use it. Maybe we can talk a little bit about what our thoughts are on this extraordinary market as well.
Yeah, extraordinary, indeed. Well, first of all, thank you, and I'm humbled. Preeminent is a big word, but there are a lot of people doing a lot of good work in the area of technical analysis, or otherwise known as studying price instead of facts and figures, yes, about a company or its management or its earnings prospects or its competition and its lines of business. And so it's an open, just as so many areas are, it's an open arena to all. And I think the first and foremost thing is either one accepts or doesn't accept the concept that there's wisdom in price. The government understands this. They include stock prices as part of one of the inputs in the leading indicator index. And the general principle, when I say respect price or that there's wisdom in price, it's something that was controversial. Let me just say that. It's been 3 minutes on this when it was sort of first embraced. And it goes back some 200 years. I think there's candlestick charts in Japan studying the rice markets, supply and demand from traders as old as that. But certainly in this country, back 100 plus years. And controversial, people say, well, you're going to buy the common equity, this common stock in a company, but you don't know whether they make sneakers or sushi or soda water. How can that be? What if they have a lot of debt? You wouldn't know that. What if their lead product counts for 70% of their business and there's a major competitor whose product is better? What if they have one customer that is 20% of the business, that customer is about to quit them? What if, and so forth. And so generally speaking, the way of the world is to study a company, and again, its products, its truck routes, its margins, its management, and all of the things, and then come to a judgment about what the shares in that company are worth in the future, or said differently, just a present value of future cash flow, whatever model one wants to use. But in the simplest form, charting doesn't say disregards all that, but the chartist is trying to essentially just be what a bookie is. A bookie is just following the money flow, right? And trying to determine based on how the bets are coming in, what is the likely outcome. Because people who are betting have done it for a myriad of reasons, what they know or don't know about a particular event and the outcome. And so too it is with the market. But if I think this is worthwhile, let me just put this in very pedestrian terms, and that, well, I think it helped me make sense of it. When I doubted it, didn't believe it, I started as doing fundamentals for 2-3 years, and thought this kind of thing was nonsense. But someone that came to me, an older man, pulled me aside and showed me a few things, and it really was eye-opening. So when I was growing up, and this was before you had any sort of, and Mike, you too, you didn't have any computers per se that do all the things we do now. And you certainly, for instance, if one was opening a restaurant in New York City, let's say there's a famous food critic named Craig Claiborne. And for those who have children or might know the movie Ratatouille, if he panned your restaurant, you could close it that night. You could pretend and close it for 2 weeks, keep it open for 3 weeks or 4. You will close. He ruined you, right? What he said, that's it. He was the man. And so that concept was that an expert could deliver you information. And that's the same thing even to this day. So if a company, an expert, a major securities analyst at a major bulge bracket firm, the big names that are household names from Merrill Lynch or long ago, E.F. Hutton, from Morgan Stanley to Dean Witter long ago, this kind of thing, a major firm and a smart analyst would put out a recommendation, puts out one now, that therefore that analyst knows, right, that analyst has insight. And indeed, that is the current construct on Wall Street, still is. But the other way to do it, and this has now been embraced, is that rather than go with one man or woman's opinion or 4 or 5 or 10 experts, like a food critic for a restaurant, but we had something called Zagat's originally. And now it's just everything. Everyone goes and looks what the reviews are, the vote, right, from hundreds and thousands of people. And almost invariably, that's accurate. With the restaurant, yes, in particular, ones that have low ratings aren't good, and ones that have very high ratings are good. So that premise is what the study of price action is. It's saying, I don't know what this company does, but let's say it's software, if it's good or bad software, if it has a winning model, if its balance sheet is in good order and its prospects are good, and therefore it will go up prospectively as an equity. But rather, one is just studying the money flow every day, big bets coming in. And what one says, what do you mean you're studying it? Well, the key is volume. And we'll spend one more second on this, and then maybe I'll yield the floor here, but I think it's important. So the volume, we're looking for more than anything else, not some magic oscillator like RSI or MACD or Bollinger Band or DeMark or overbought or sold, not moving averages, and those are, you can do any way you want to get to heaven, but it's the key is volume, unusual outsized activity. And so let's try to tie this all together. The premise, if I were to right now stop literally and say, wait, Mike, I got to tell you, I forgot to say this. If you next time you're in Atlanta, you've got to go to this restaurant. Imagine interrupting the Zoom. And you said, what? I said, no, stop everything. Write this down. Get a pen. I write down. Now, if I was that emphatic, right, surely you'd think, well, Carter must have been there 2 nights ago. Or I go there all the time. And then you might think that I host client events there and that I really know this well and that's why I'm so into it. And in turn, I also, perchance, am the son of a restaurateur. And I know a lot about restaurants and all of the food world. And I did a little bit of studying in Paris in the culinary arts during college. That advice giving to you, that emphatic advice about this restaurant, was because I'm knowledgeable of the restaurant in question. I've been there, I've eaten there, I've tried all the different desserts. And indeed, I'm not a food idiot. Who cares what Carter likes? He actually studied the culinary arts. Again, he's the son of a restaurateur. And that therefore that recommendation to you, whether it's a major securities firm or Craig Claiborne from the New York Times restaurant, that has value. That's input. That's going with one expert. The premise, my premise of charting is this. Here in New York, I live in New York, right? Work in New York. So I go down to the West Village. It's a Tuesday night. I'm a food idiot. I can't tell the difference between a hot dog and a good kielbasa. I just assume have a Slurpee instead of a fine creme brulee. And I notice across the street, there are 5 or 6 restaurants. Restaurant 1, sort of full. Restaurant 2, sort of full. Restaurant 3, empty. Restaurant 4, packed, line around the block, et cetera, and so forth. I come back on Thursday night. I know nothing about food. I've been in none of those restaurants. I notice the pattern. Restaurant 1, sort of full. Restaurant 2, sort of full. Restaurant 3, empty. Restaurant 4, packed, line around the block. I come back one more night. Saturday night, it's raining, getting wet. I'm just eating my Doritos. I know nothing about food. And I see restaurant 1, sort of full. Restaurant 2, sort of full. Restaurant 3, empty. Restaurant 4, packed, line around the block. I've never been in restaurant 4. I can tell you, the meats are succulent. The vegetables are glorious. The tables are spread apart beautifully. The music's not too loud. The wine list is excellent. Everything. The hostesses are lovely. The idea is that that's what a voting machine is, and you refer to, so a line in front of a restaurant tells you what you need to know. We're looking for unusual lineups. Wow, look at the volume. It only trades 1 million shares a day, every day for months. It's 600,000, it's only 940, and the stock's up 10%. Something's going on. And so this is, now it's, and I'll end with this. They're going to say, but you're relying on, you're willing to, it's not a restaurant, Carter. You're willing to commit some of your IRA money or recommend it for someone else in a stock that you know nothing about. In fact, you don't even know what they do. But that's the, the Immanuel Kant, the conscient leap of faith, where you can only go 3/4, and many people can't do it. But I've done it. I never look at the fundamentals. I am making recommendations from the largest capital pools in the world, hard stop. And they know when I'm saying buy or sell it that I have no idea what business they're in. And so this is the idea. And then one more, just for fun, about this collective wisdom, to put this in context. But there's so many examples like that restaurant. There was a game show, of course, that was on for years, and you might remember it was called Who Wants to Be a Millionaire? And the general premise was a contestant would get up and answer a question. If you could, great, you go on to the next. And if you could, go on to the next. If you could not, if you were stumped, you had 2 choices. And the choices were, you could call an expert, call up the great man at Merrill Lynch or woman at E.F. Hutton, the analyst, the star who knows more about the subject, or you could turn to the audience. Now, who in the heck would ask the audience? I mean, who's in a game show in the middle of a workday? There's a bunch of unemployed people. Why would you turn to the audience? So in comes the question. Let's say it's something esoteric on the Civil War. And you're like, oh my gosh, this is beautiful. My father-in-law's one of those Civil War nuts. He reenacts it on the weekends. He wears the uniform. He taught at West Point. His subject is the Civil War. Perfect. I'll ask him something on Appomattox, whatever it might be. Guess what? The stats are as follows. The experts get it right throughout the history of that show about 7 out of 10 times. The audience, 9 out of 10. That's collectivism. Who's in that audience? Maybe there are 3 retired generals. Maybe there's 2 professors currently from West Point. There's wisdom in crowds, not hysteria. We're not talking about that. That's all that charting is. It is not about oscillators and indicators. It is simply accepting, and it's trying to remove one's own ego and say, there's something that must be going on for there to be a line outside that restaurant. And that's what we're looking for.
Well, I think that that captures it quite well. I've often spoken about the wisdom of crowds. I don't know if you read that book. It was basically it was a line of thinking that was developed after somebody observed they had a game at a fair. This was, over a century ago.
It was an English fair guessing the weight of a heifer. Yeah.
Yeah, they were trying to actually guess, if my memory serves me correctly, the weight of a butchered ox. Yep. So they showed the ox, and then you were supposed to estimate how much that was going to weigh at the end. And now the thing about these fairs, and they still hold them to this day. If you go to agricultural rural areas, they have county fairs. Mm-hmm. And one of the activities that goes on at these county fairs is people bring their livestock. They show it off. They sometimes auction livestock at these things. So these are well attended by experts, but they also have games for the local community, and somebody tows a Ferris wheel in and things like this. And so you have people who are not experts, but what was observed when they did an analysis, much like you describe, is that the crowd was able to make an incredibly accurate guess. All of the participants, when you took and some of those guesses were ludicrous. Some probably said it would be 5 pounds, and some said it would be 5,000 pounds. Both were obviously absurd guesses, but in the aggregate,
it's within like 3%.
The net vote,
something very tight. It's incredible.
The net vote was almost exactly right and more accurate than any of the experts had guessed.
And there we have hundreds of years. It's fascinating, and it defies. Well, it's hard to do, right? Because it's suspended. One says, but I was top in my class. I was the valedictorian. Then I was admitted to Harvard, and then I did get hired after MBA at Harvard again. And I did get hired. I'm the expert. I work at the finest securities firm. I am the one who will determine and can determine better than all what this security is worth. Well, that's ego.
Yeah, we had a couple of questions, and I wanted to get to sort of a broader conversation about how some technical analysis could be deployed to come up with a systematic strategy, because you have done exactly that, and may well be coming out with an announcement about it soon. But I was going to read one of the questions that somebody had texted to me who knew that you were going to be coming on. And perhaps you could give some thoughts on that. So, hi, Mike. For Carter's upcoming appearance, well, your appearance at the moment, would love to hear him address the following. So, on market structure and technicals, your charts often highlight support and resistance and moving averages. As we head into year-end, well, this seems like it's many answers might be in here, but which sectors do you see providing leadership? Are we likely to see continued dominance from technology and communication services, or do your charts suggest a broadening into things like cyclicals and financials? And this other questions that he has, we'll get to that, because I think we're going to be talking about that when we talk more broadly. So what are your sort of general thoughts on this pretty extraordinary market that we're
that's right. I mean, in terms of leadership, there's always something that's outperforming something else. The Wall Street nomenclature is leadership, and then to impute to that meaning. For instance, financials are doing, in many cases, just as well as tech. I mean, Goldman Sachs, Morgan Stanley are as steep and uncorrected as many technology names. But in general, the leadership is technology or innovation. Let's call it that. The notion of growth versus value. These are odd nomenclatures. I mean, or even timing. I'm not a timer, someone might say. We have clients all the time. They're deep value. We don't time. Everything you're doing, you're timing. What do you think? Warren Buffett, every stock he bought, he thought it was a good time to buy it. I mean, this is nonsensical. The words are nonsensical. Value versus growth. You bought something that you thought didn't have value, was overvalued. I mean, anytime you buy something, you think it's going higher. Anybody, which means that you thought there was value at the time that had prospective more value in the future. Now, it's the nature of Wall Street to want to categorize things but this language of value growth, that you go back, it didn't exist in the 1930s and 40s. Did you buy or didn't you buy Alcoa or International Paper or Dow Chemical and DuPont? What's working? But it's this need to categorize and put everything into thing. And I'm not admonishing the person who's asked the question. I'm saying there is no answer to that, other than to say one is right to always respect relative strength, right? Of all the factors that have ever been tested and tested to this day in the biggest quant shops in the world, basically, momentum and relative strength are what work. And you see it in so many. You see it in sports. A team has got momentum, and then you can feel that. Wow, they're on a roll. It's an expression that we use, and it's in all things. In life, there's good and bad periods of success and winning, and then setbacks. I mean, just hypothetically, you are the star person, boy or girl in high school. And guess what? That momentum continues. You become the star, in university, and then guess what happens? You get the big job, and then you get the glorious apartment, and then you get a great date, and then a girlfriend or boyfriend, and then guess what? There's also the opposite. You lose the job, you lose the apartment, you lose the girlfriend. There's momentum, boyfriend, up and down. And so it really is just following strength and respecting strength. And so to that end, I mean, if there's going to be trouble in the market, it's trouble because the strongest falter. As of now, there's no indication that that's the case. But in terms of their industrials, GE is up. I mean, I could do this quite. Let me just do 1 second. Let me just look for fun. I'll pull this up. Do it. Here, ready? GE. Let's just see. We'll pick a financial, and we'll pick year to date. Why don't we do?
How about Wells Fargo?
Yeah, perfect. So, because that had some news there. So we're going to do WFC and then XLK. That's the tech. And why don't we do an industrial GE? Okay. And we'll do year to date. Well, Wells Fargo year to date is up 23.1%. The XLK is up 22.2. Wells Fargo is a 1 point better, 22 versus 23%. GE is up 79. That's industrials, right? So it's a lot of these great winners are in the technology sector. Netflix is up more than that, or Palantir and things like that. But there are plenty of big winners throughout the market. And I don't think it's thematic so much. It is just idiosyncratic. There are things that are doing very, very well. And I would respect those as leaders to continue.
So let's see here. I think we have a couple other questions. And this one I think speaks to this. FinWest is asking us, are there technical indicators? You mentioned volume, and then we were just talking about moving averages. For as long as I've known you, the 150-day moving average was the one that you seem to have used most. In fact, I actually don't remember anything else. And it seemed like we were able to divine quite a lot from that. Maybe you could speak to that.
Yeah. So here too. So in order, think about the original charting text. The only text I've ever read is Edwards and McGee. It's probably on its 7th edition. That was in the 40s. To have a moving average, you have to have a computer. So even moving averages are relatively new in the area of technical analysis, in the sense that it goes back 100 up to 200 years. And so you say, what do you mean? That's not true. Of course it is. So how would we create a moving average and then get around to 150? It would be 1950 and 1940. We'd have Inland Steel or Bethlehem Steel. And so we'd wait for today's closing price, 22. And then what would we do? We have them all in a piece of paper, and we'd add, this is the 150th, we'd put 22 on, and we'd take one off 150 days ago. Then we'd add them all up, divide by 150, and we'd draw it with a pencil, add the new line. How could you do a moving average? It's a computer. Moving averages aren't a part of any seminal tax on the area of time. So all that a moving average is, it tries to smooth out price, right? Trailing price. And look, they use a moving average, and they used in economic data, right, to smooth out spikes and things that happen for a variance rate in 1 month, but to take a 3-month moving average, and that gives you a blended, just as Cape Shiller does it for the PE, right? Instead of one particular moment in time that could be excess of a spike in a stock because of a rumor or FDA approval, we look at a flow, if you will. And I call it, the smoothing mechanism, smooths out price. But you're just trying to measure trend. And generally speaking, if you have a security that's been ascending, moving from the bottom left to the top right of the screen for a period of a year or more, definitionally, necessarily, its average trailing price over 150 days will also be rising, and it will be below the price. Price and trailing behind it is the moving average. And in turn, a stock in a downtrend, like UPS now, just an unrelenting downtrend, its moving average, its trailing price over 150 days, or whichever one you're using, will be in a downtrend. And we're looking for changes in trend. That's so very important, right? Where a stock in a long and protracted decline starts to stop going down, base of sorts, and actually inflects and turns up, which is best seen by a moving average flattening and starting to turn, and the inverse where a stock tops. But if you look, I would just say this, that I did a lot of work on it with my teacher and mentor. He in turn started the Fidelity chart room in the 1950s and 60s. And you can do your own work, but I will tell you when this question comes up, and it's come up for 30 years, it comes up in meetings. I had this as recently as last week, someone who was new to the firm. The other people all know the answer. He said, well, why do you use the, and I always start with, well, why do you use the 200? There's a bit of a silence. I've gotten 3 answers in 30 years. The first is, well, that's the number of trading day, something, no. Something that's just not true. The second is, well, everyone else use, wait, what? You mean you just sat down in the car, just started driving that way? What does that mean? You didn't adjust the seatbelt or figure out the seat? Just because Investors Business Daily is the 200 moving average and other prominent publications, William, that's the one that you're going to go with? Okay. And the third answer is, I just don't know. Well, we did a lot of work on it, and suffice it to say that in the measuring of trend and changes in trend, and if I just try it yourself anytime you'd like, you could change your software. It is a higher hit rate in terms of where a price is and where a stock that sells off the trend bounces. Even this, this, and it's a terrible indicator, but you get great name, and so therefore people love it. Golden Cross and Death Cross. Oh, it sounds so wonderful because it's so golden, and then the death. It's it. Do you know what is that? That's a 50-day, a short-term moving average crossing above or below a longer-term moving average, 200. So if you were to go back and, for starters, it's a terrible indicator. By the time a short-term moving average is crossed over a longer-term moving average, the stock is down considerably. And in turn, a bombed-out stock, yes, that's starting to heal. And by the time the 50 has gotten above the 200, you've missed 20, 30, 40%. But if you were to engage in that kind of thing, which has its purpose, right? They're trying to say, look, you're looking for changes in trend. Do you know that 80% of the time when a short-term 50 crosses above a long-term 200, the 150, just one moving average, that two, has already inflected and gone flat. So one is better than two. It's simpler. It's tied to, I believe, when we can talk about this another time, but go to the website if you like, Worth Charting, and there's a long video discussing just this. But it's tied to the quarterly phenomenon. There are these spikes up and down associated with earnings because the ability to predict earnings is almost zero, and that's why you get these gaps. And the moving average that best sort of captures that is the 150-day. By my work.
So actually, it's interesting. We have a viewer who's asking what your take on eliminating quarterly earnings reporting, which has been thrown out there in some quarters. What are your thoughts on that?
Sure. I mean,
think that would change one's technical analysis techniques if they did?
Yeah, I don't have any thoughts on it other than how do we, whenever you have to think about something, you have to think, well, how did we get here? Well, the government gets involved, and for better or for worse, if there was no earnings, no reporting, you just had to trust me, I'll see you in 10 years with 10-year lock, that would be hard to cope with, right? And so it's intended for a moment of transparency to have some regular information that is deemed to be accurate, certified by an accountant, about the operating business that the investor can use to make judgments and to be informed as best as possible. I will tell you, I have a lot of, this has come up with institutional managers and specifically analysts within, when you're talking to a portfolio team, and many who cover European banks, for instance, and they said, that's sometime when it was on 6 months, it's a disaster. You're in the dark, you have no idea, and it's too long. And some people say you don't need to report every 90 days. It's too frequent. I don't think there is any right or wrong answer. I think transparency is always better than non-transparency. And whatever the frequency of that is, it is. But I don't think changing something, you do it if it's broken. Yes. Is there anything broken about the reporting of results on a quarterly basis? My hunch is, and I've heard this from PMs, that the overwhelming majority of companies are not for changing the current construct. They believe in the quarterly process, but I don't know where we stand on.
No, I agree with this. I think the biggest criticism that we used to hear about quarterly earnings results was that this somehow was negatively impacting the actual operations of a business because management was too focused on those results. I don't buy that.
Nope.
There are a lot of businesses that require a considerable amount of runway, capital investment for projects, multi-year planning. And, I think this kind of transparency allows investors to get an understanding for how those things are going. And they've done a pretty good job of, creating tremendous, productivity growth, economic growth. And, the companies in the United States are the most successful in the world by a substantial margin. So, if we were able to point to that and say, I think this is kind of the point you're making, if we were able to say, look, quarterly earnings reporting we don't know, but it might actually influence management behavior. And the byproduct of that behavior is that our businesses are underperforming, then I would say we've got something to point to. But in fact, that's not the case.
Yeah.
And we don't hear companies complaining about it. We don't hear institutional investors complaining about it. I sometimes feel like these types of ideas get thrown about when there's somebody who needs something to complain about.
Yeah.
There's somebody who needs to be able to say, "Oh, I've got a better way of doing things." Oftentimes without evidence, it should be said. There is no evidence that reporting earnings once a year is somehow going to be better than reporting them once a quarter or twice a year.
It's the bottom line is, right, that information is good, not bad, and the sharing information or being required to, but no one made anyone go public. The privilege, right, or the opportunity to sell your part of your company to the public, that the government is trying to protect against bad actors who would hide and never report earnings or just give you bad information that would be untrue and induce you to act on something that was false, and so forth. So there's a reason, and look, and there's a reason everyone wants to. Why do you think they do press conferences after a sports game? They'll answer a few questions, but if you went in the locker room, I want to know all your plays. Tell me all the plays. No, thank you. Sorry. Or the Mars family with the candy business. You guess what we're going to tell you? Nothing. Do you like the candy bars? Good. I mean, it's private. And so, if you want to operate in the public markets and have the ability to become, how big was NVIDIA 30 years? It wasn't. And now look at it, right? Mm-hmm. The point is, if you want to sell your shares, and what's wrong with having to, and think about the productivity of annual meetings, of people being asked questions or quarterly calls, or anyone can get on and, ask a question. And that's so do in courtrooms. They ask a lot of questions.
Yeah, shareholders have a right, I think, to have a right to know what's going on in the businesses that they own, even if their ownership is relatively small. So I thought we might just talk one. I have on my screen right now. It's just GLD. It's the ETF GLD. I have the 150-day underneath it. I think here we are. It's up again today. New all-time highs. We can see which way the trend line is going, and I think are you showing my chart, or I think we might be showing what? Oh yes, okay, we are showing mine. At what point does one, looking at the moving average, say, okay, this is pretty steep and uncorrected? I think these are terms I've heard you use quite a lot. or well above trend. Um, how do we begin to think about characterizing this for our own use?
Yeah, so that's what an oscillator is. People, an RSI would depict that and others, but I will just give you the information as it stands. We are 24% above the 150-day moving average. Now, if you use gold itself, gold spot, go back to the 70s before we went off the gold standard. Before that, of course, it's a fixed market. There are only one or two other instances in history where it has been this far and continued higher. And the two big periods, of course, are the great period from 76 to 79, 80, when silver also spiked. And at one point, we were 50% above the 150-day, which would imply this goes a lot more. And at one point, 100 at the peak, 100% above the average trailing price over 150 days. And then it crashed, and that was that. The only other period was in sort of 2011. But every time, and there have been a lot of them, where you're about 22%, 23%, we're 24 now, you have seen a correction, a dip, a drawdown, a decline, a drop, a pullback, a give back. The nomenclature is irrelevant, of import, 7, 8, 10, 12% or more. So this is either, again, 1979, 80, and we've got an exceptional period. But it is important to note that, remember, gold only 2 months ago, adjusted for inflation, got above its peak of 1980. And so that is shocking. And silver, of course, is well below its inflation-adjusted peak, even now.
Yeah, that is helpful. I mean, I've obviously been, I've been sort of on, as I know you have been as well, bullish on gold for the last couple of years, but the recent price action does stand out as being quite unusual in the period of time that I've been watching it, which is as long as I've been in the business. And I think there's only one period since I've been in the business, and that was what you referred to in 2011, that we had this kind of sort of outperformance relative to the moving average.
Just for fun, if you want, I don't know if I can share a screen. I'll show you the three other periods. Okay, great. I'm going to do this one here. All right. Here we go. Is this coming up? Okay. So this is the current spot gold. That is the 150 moving average. And you can see we were 19, 20% above. We were 25 in April. We're 24 right now. Now, here is 2008 to 2011, 20, 23, 26. Here is, sorry, and here finally, did I miss? Oh, well, I missed the best one of all. I might not have that. Bear with me. Maybe I can do it here. Sorry. The 79 XAU. Currency G12. Let's see if I can pull this off. Okay, and now we're going to do 1976 to 1981. And
oh yeah.
Okay.
Look at that.
Let me try one more. Is this G17? Okay. I don't know if I might just give me one more second. I know this is tedious to watch someone on their computer punching keys. Here we go.
The people who are watching are kind of used to seeing me fiddle around with it. So.
All right, so here's the current, right, that we just looked at. So I'm going to go and so this, just to be clear, the current one is this, 21, right, and we're 24. The only other period that was extended, but is 20, 23, 26, that's 2011. And then the final one is right here, 1976 to 1981. And let's see. So I'll show you the 50% and the 100%. So there you go. and I'll change it to log so you can see it. Okay, so this, again, 20, 20, 20, it was 50, and then it was shocking. So if we are looking, if a lot of people say this is analogous to that, and this is what's happening, uh, then, that would argue for this has a lot more to run. But again, where we are now compared to the two other periods. So I'll do one other chart to put this in context, an all data chart. Let's see if we can do that. That'll be here, and we'll go from there to 2025. And you will see log. Okay, so now we change it to log. That this current reading, here comes the log chart. This is, again, that's the 2011 that we looked at, right? That's just 2000, see the dates, 2009 and 2011. That is right here, 2008 to 2011. That's this. And all of these are less. And then the current period, 2022, right, from 2020, that's this. And the only other one is the one we looked at together, which was here. And that is this. Gold went from essentially 115 an ounce to 900. But the point is that you get to about 20 and you correct. So either this, we are on pace for this is where a normal correction pullback dip occurs, or this is, we're about to do, have a blow off, but it means a lot higher. Some people say 5,000, 7,000. So this is either the, history repeating. Now, I'll leave this to you, Mike, as someone who, not the technicals. I have this all very much in my mind day by day. That's why those arrows and lines are there. I'm looking at everything. But we can think about the backdrop then, and that I can't speak to. I guess there was a high inflationary period. We know this, right? Treasury yields were 16%. We don't have that. So how this compares to then, fiat currency, debasement, it goes on. I can't speak to that. But
we had, we had much higher rate of inflation at that time. The short-term Treasury rates, as you indicate, were in the double digits. You could go to the bank and you could get a CD that was going to pay, 15-ish%. We'd had this. It was just following the second of two oil crises, with sharply rising oil prices. So oil was essentially $3 a barrel forever until the first oil crisis in, I think it was 73, and then there was another one about 5+ years later. And so that was really the backdrop at the time. We have a very different one now. We were also going into, let's hope that's not the case, but there was a recession as well. So we had a really unhappy confluence of things going on at the same time. We were on the heels of an oil crisis. We were in stagflation, which was a combination of recessionary periods and very high inflation. So it was quite extraordinary. I would argue this is slightly different. Although, it might be that the gold markets are anticipating something like that. I think a lot of people are referring to this as a debasement trade, but my thinking is that, if we take the economic backdrop into account, then one would have to think that what we're going through right now is more akin to that 2011 period than it is to the late 70s into the early, to 80 and 81 period.
Right. I mean, here's yields. I just
that would be
perchance change it to yields. There's the peak in yields, right? Almost. Treasuries got to 16% and gold. So, I mean, that gets to the, half the people that say, well, gold is basically because of deflation, it goes up. Others say it's because of inflation. I would say, look, I'm not in the why business, I'm in the what business. It's going up or it's not going up, but it's extended, right? So unless this is the one that records are meant to be broken, as the expression goes. Idioms are important part of language. If this is the one that makes the 79 broken or the record, then much higher. But otherwise, yes, is it 11 or is it some other somewhat normal period and therefore, extremely overbought.
So, I think at this point I wanted to make sure we left some time to get into, how you use options. And, what I've really become aware of is sort of your approach to using technical analysis and price action to identify options trades. One of the most common things that, it gets talked about on the news. It's in the paper. It's in Investors Business Daily. If somebody writes an article, Stephen Sears writes an article in Barron's, we've got a company, they're going to report earnings. What's the options trade we should do ahead of that? And in fact, this is something that I do all the time. A big part of my every day is to say, okay, what catalysts are coming up, and how might I try to structure an options trade around that? But you have a very novel approach to all of this, which is that you do use options and you do use catalysts, but you turn this completely around, which is to say that you wait for a catalyst to identify an opportunity rather than trading into the catalyst as an opportunity. Maybe you could talk a little bit about that.
Yeah. So, I as you would know the statistics on this, but short-term moving average, I don't know what that means, 1 month expiration, but a great preponderance of them expire worthless. Is that correct?
Yes.
Yeah, I don't know what the number, 80%, 90% or something. And so we've all had our trials and tribulations. There's not any futures contract from cocoa to cotton that I haven't bought and sold, or any bond derivative or stock or penny stock, tried it all. And over the years there, there are things that you come to respect as being exceedingly dangerous. And I would say that short-term options are that. They're lotto tickets for many people. They're, and if you catch a, you catch a big winner, you get these things that are 10 baggers and 20. And then there are more conservative things like risk reversals and what iron condors, right, where you're, and butterfly or so forth. But I myself, I basically am a seller of premium in line with that general idea that a lot of the short-term options expire worthless. And so one is essentially, look, insurance, I believe the British invented insurance. Insurance is a very good business. And Warren Buffett has proved that, as so many others. It is an incredible thing. It's the only, and certainly life insurance, right? While you do ultimately have to offer up a product that the person pays for, you have to give them the money. It is something that you, in a lot of areas, you never do, right? So no one goes and buys insurance on their home and then walks out to the front lawn and says, "Burn, baby, burn." You want it to pay off. And it's an incredible thing. There are very few places where you can offer a product to someone and never have to give it to them. They pay you. And that's what insurance is, right? And so if it's done properly, it's highly, highly lucrative. And we know that some of the biggest companies in the world, whether it's Lloyd's of London or Berkshire Hathaway or MetLife or Pru or Allstate or Hartford or Geico, can be very profitable if you manage it properly, prudently. And so what I essentially do is I sell premium. So after, not just randomly any old time, it's based 100% on price action, but after an unusual move, higher or lower, in a stock, typically this would be after news, it's earnings, 90% of the time, you will see a great pop or drop. And the premium, let's say it's a pop, and probably was there any big poppers today? Let me just, here, SPX index movers. Let's see, who moved today? A lot. In the S&P. Here, BG. I guess that's, I believe that's a commodities. Bungie? Yeah. Okay. So BG did this. Let's see. Popped, must be earnings. And if you went over and went to ERN, there was no news today, so then it's going to be something else, not earnings. For fun, let's see what it was.
They did actually.
Pre-announced.
They did actually have some news. Yes, they pre-announced.
There you go. Okay, so it's almost.
Which would have been particularly difficult for somebody who was looking ahead to earnings to trade, because the results came out
before
off the calendar.
That's right. It's always exactly. So now, if we were to go and let's get rid of that, and let's do the chart again, G12. And now we're going to look at this. Let me see if I have to change the dates. Ready? So here we go. Now this will be better. So Bungie pops like that. Someone made a fortune today if we could find the calls, and we'll look at that. But my idea is to do something different. Okay, so now here we go. OMON. Options. All right. So for Fridays, for next month, ready? Next month, the 100 strikes, 2 bid by 230, close at 210. So those today did this. They'd closed at 13 to 37 cents, and they went as high as 350. That's a 10-bagger. Somebody made a fortune, right? That's the dream of buying options. You bought the thing at 35 cents, and it went to 350. Okay, but let's go back. So now, if we, again, look at that number, the 100s are closed at 263. All right, so let's go over to our chart, and what we do in an instance like this is as follows. The 100s, put that line at 100, and now we're going to look at some puts. The 87.5 puts, let's expand that a little bit. We'll do a round number. The 85 puts went out at $2.05, but the bid ask was 140 by 190. Let's say that's 180. All right, let's say it's 170. 170 would be fair. So the 85 puts, 170. Sorry, here we go. This will make sense in a second. And then we're going to copy this line and put that at 85. But that's not, so we're going to sell the calls and sell the puts, but that's not where the line belongs. We're taking in, Mike, I'm relying on you for the math here. Remember these numbers, it's 240 by 330, so say 260 in premium for the 100 calls, and the 85 puts, we agreed on 170. What does that give us? 260.
Are you looking at December or November? I actually loaded it up on the Decembers on options play over here. You're going to collect about almost five and a quarter for that 8,500.
Okay, so it's 100 is the thing, but we're collecting 5 and a quarter. So the blue line goes to 105, about 25. Ready? Enter. And the 85
takes you down to below 80.
So what is that? So 85 minus.
Just call it 79 and 75. Yep. Call it 79 and 75.
So we change this to 79, 79.75. Update. All right. Now, we're going to get a green line. Here we go. And we're going to put in the expiration, which is... What's the date?
The 19th of December.
19th of December. Here we go. Ready? 19th of December. December 19. Update. And now this is the proposition that by selling the 100 calls and the 85 puts, we're taking $5.25 of premium, that now we're in watching the spots on the banana, get more and more until the banana prospectively is black and inedible. For this to work out against us, the stock will need to be 12.5% higher by December, or it will have to be 15% lower. One would say, well, yeah, but that could happen. All right. We only do this after a news event, earnings, or something like this, which is, so now we don't have the risk that it's going to have earnings and do this to us. It's already done that, right? It has had a news-related, fundamental-based move higher or lower, right? Okay. Now, after a stock gaps up on earnings, and we're going to look at, for fun here, Apple's strangle was done, these are all done a month ago. We have 2 days to go for October. It's going to expire worthless. Tesla, we did it after that gap up. It only has to go till Friday inside the blue line. Robinhood, look, this one was against us. And one more 2 days, it's back in the collar. Oracle, after the gap up, people are hysterical. They're paying huge amounts for the premium. It's got 2 days to go. Semis, Alibaba. So we're going to do this one together right now. But what we have here, we have every single one. We do them by month. This is a spreadsheet of every single strangle. And this is this month's strangle. Total premium taken in is 51, and the current value of it is 11. 2 more days to go. I think they're going to go to 0. Sure, they're not all perfect. This one's a little against us, and so forth. But this is the idea. So we're doing one together now live. Let's do it. We're doing Bungie. This is longer typically than we go. But let's talk about why after a gap up. If a stock gaps up, it gaps up for a reason. Earnings. So it, in a way, belongs there. It's not going to give back all of it. And notice where the blue line is written. At the level from which it gapped up. Okay, let's go Bungie. Why is the blue line here? Would we buy a stock, any stock, at the price it was trading before bullish news was released, but we have the benefit of the news? So what that is you have an actor that's sort of unknown, or an athlete unknown, Leonardo DiCaprio, and then he has this big role called Who's Eating Gilbert Grape? And all of a sudden, there's like, this young actor's a star. Guess what? The next movie, he doesn't do it for 400 grand. His agent says, the price changed. It's now 2 million. Oh, so we get to buy DiCaprio, an actor, before the breakout role at the price that prevailed before the breakout, but we know the future. The breakout role is coming. An athlete before the big season, just like in that Jerry Maguire, right? And then you have the star season. Then, hey, price changed. And so we do it after a stock is gapped up, typically. Oracle or Tesla did this. This was the news of something, or Apple after it gapped up. And so you're getting people who are crazy paying too much, I believe, as the insurance seller. You want to buy that premium from me for on the put side. Or let me show you. Let's do CarMax. So this was one done to the downside, and then we'll go back to Bungie. So CarMax dropped and gapped in horrific fashion. You see CarMax? Look at that. It dropped on that day 21%. So we go and we sell. Here's CarMax. The call strike was 47.50, 37.50 puts by 47.50 calls. So adding the premium, CarMax has 2 days to go. I would bet everything. So is CarMax have earnings tomorrow? Nope. That's out of the way. FDA approval for a drug that's going to make it? Nope. Could it be acquired in the next 2 days? Sure. But notice we try to do some of these. No one's going to acquire Apple. No one's going to acquire Tesla. No one's going to acquire GE. Blah, blah. We don't,
no one's going to acquire CarMax.
No one's going to acquire CarMax. Guess what? Because it's a loser. Right, exactly.
Yeah.
So anyway, this is the idea. And I'm not sure that answered your question, Mike, but we thought visually this is what this is all about. And so we try to sell premium.
Yeah. Yeah, I wanted to just show a couple charts of myself if I could. So if we could pivot over to my screen really quickly. What is interesting about this to me, and maybe to those of you who are also watching us, it's really common for options traders to talk about event variance, which is how much options prices are factoring in the potential volatility that could surround an upcoming event. It could be an investor shareholder meeting. It could be a lot of times you'll see companies participating in conferences. These are other things that can move a stock. So these types of opportunities that Carter's talking about don't only come up around earnings. They most often will be earnings or pre-announcements and things like that. But the thing is that around earnings, you often will see a lot of premium baked into options prices ahead of time. A lot of people speculate by buying options, hoping that they get the direction right, that the stock is going to move sharply in the direction that they expect. What is interesting about these circumstances in particular, from an options trader's point of view, is that the vol crush that often follows that event. All of this frenzy, people betting that the stock's going to go up or betting that it's going to go down, they start bidding up the price of options, and then the news comes out, and inevitably the price of options goes down or doesn't. So in the CarMax example, which I have up on my screen right now, what we saw is that this catalyst came along, the stock was hard hit by the result, and options premiums did not collapse immediately thereafter. In fact, they remained bid, which meant that you could now sell elevated options premium with the benefit of knowing how that event turned out. We already know how it came out. It turned out badly, and the stock gapped lower. In the example that you provided for Oracle, the same thing happened. Because the event was so profound, the move was so sharp, it caught a lot of options traders off guard. And the net result was that premium remained elevated. So you actually have a situation where you have the benefit of both the hindsight that whatever that catalyst provided to all the investors that caused that price jump in the first place, higher or lower. But you also have the benefit of finding elevated options premiums. And one of the things that we know about options prices is that volatility is generally mean reverting, which means that there's this period during which folks are trying to digest what they're going to do next. But there's sort of an offset where you have the price movement has taken place, but there's still an opportunity to sell options premiums at elevated levels. And, I happened that spreadsheet that you showed, I've done a little bit of work with that spreadsheet, and, you get a very, very attractive risk-adjusted rate of return from this. So there are price jumps all the time. Do you basically just screen or just monitor for price jumps generally before you identify these strategies, or is there other sort of technical work that you do in conjunction with that?
Yeah, well, the levels. So this is the one instance where, so the first thing, of course, when you're naked, you'll notice they're very large. So we eliminate the going to get bought out problem, right? And then you notice there's no biotech, right? Because that's truly playing with fire, right? You have a 10-bagger against you both ways, and so forth. So and so it's large cap, prominent, and we stay away from. And it's after a big re-rating, a big lurch higher, lurch lower. And so the first thing we're looking for is unusual one-day moves, and then looking over. Okay, this is think about, would you do it on a again, it's a McDonald's. So let's go to acquire McDonald's. Cannot happen, right? And McDonald's not going to come in and, have some horrific thing. Oh my God, it's down 30%. It's businesses that don't have that. And then also, you wouldn't do it on a retailer like a Crocs or an Urban Outfitters. Those could get acquired, right? That's in the CarMax, you'd say, I know that one is such a dog, right? That highly likely. But would you do it on something Williams Sonoma, or this is the kind of thing where you could have yourself a big problem. Now, to be fair, the idea is that even a strategy like this, with enough of them, right, that you can sustain a hit like that. But we haven't had that because of the stocks we pick.
Yeah, so your plan is actually to launch a product, hopefully, that is going to engage in this type of strategy.
Yeah, this
right?
strategy and this
would
strategy.
be an investable product.
Yep, that's correct.
I think this is quite exciting. It should be said that we've talked about it a little bit on this channel, but it's only relatively recently that ETFs and these types of products have begun to adopt options in considerable size and volume, largely because there's been some clarification on SEC rules and things regarding this that have made these types of things possible. But I also think that there's a good deal of wisdom imparted for those who are thinking about how they might use options to remember the things that we were just talking about, which is that most options do lose money. So you can think about it this way. Of course, how many expire worthless? Well, every out of the money call will expire worthless, and every out of the money put will expire worthless. But of course, there's also a number of options in the middle that may expire with some value, but that value may not be as much as their peak value when they had a lot of extrinsic value. So we know mathematically that most options will be losers. It has to be true.
Mm-hmm.
And so the question is, how does one identify, which options to sell? This is something that Tom Sosnoff and the folks at Tasty Trade, they would beat on this all the time. Selling strangles, which is what you're suggesting, was one of their favorite strategies. The only difference was that when I saw them talk about it, they would rarely look to the behavior of the stock. They would just look at the price of the options. Tom would often say he didn't know which way a stock was going, so he would just sell 20 or 16 delta strangles, meaning he'd sell a 20 delta call, and he'd sell a 20 delta put, or sell a 16 delta call and a 16 delta put, and essentially be agnostic to the direction of the stock, agnostic to the stock. But it seems to me that this is adding one step to that process that is particularly thoughtful, which is that, of course, when selling options doesn't work out is very often because of a sharp move,
Right.
because news came in that people did not anticipate. If they had anticipated it, it would have been baked into the stock price to begin with. So a price jump, by definition, means new information has
Right.
arrived. And very often people are tempted to sell options premium ahead of that because they see the prices are bid. So dollar signs in their eyes, those are expensive options. I will go sell them. And they'll blindly sell them because they're expensive. They are expensive for a reason. They are expensive because the crowds are rushing in expecting a big
Right.
move. They don't know which the way the move will be. And in this case, you're looking at those select cases where that move takes place, the options premium remain bid, and you have now defined some levels, and you also know that there's probably a window of time, not certain, but most likely, that some new shocking information is unlikely to arrive on the scene before the date your
Right.
options expires.
And then the idea is that just in terms of returns here, this is worth spending 2 seconds on that. The idea is that, and we could probably calculate the Bungie one together now, but basically,
That's 31%
okay,
annualized.
so it's 31% in, collecting, what was it?
Yeah, it was one of the first things I did. So you're getting 5.25 over the current stock price. We'll call it $5 over 90
Okay.
in 65 days. 365 divided by 65 times, $5 over 90, and you get 31% and change.
All right, you do that all day long, right? 31%, I mean,
And that's 31% annualized, assuming that the stock can do some things, either go higher or go lower or stay where it is, and that's the rate of return. You will only begin to lose in the event that it exceeds these boundaries, the blue lines that you have just provided. So it's a whole lot easier to, and it's one of the reasons why, I don't know, what was the success rate on the strangles? Profitable? It's over 70%, right?
yeah.
And I think the reason for that is clear, that several things can happen. The stock can stay where it is. It can go slightly higher. It can go slightly lower, back to, in this case, back to whence it came. And losses will only be incurred if it moves very sharply higher or very sharply lower. And it's interesting, of course, because whether you bought the stock or sold it, you're going to take the risk of the equity in any case.
Right.
So this is only taking an equity-like risk, but in the event that it has made a more profound move, in this case, close to 10% in either direction in the course of just 2 months. Well, for those of you who are tuned into this live and had some questions for us, I might scan through here and just quickly see if there's one last set of questions that we might try to hit on. Let's see here. So one person is saying, so neither one of you would buy the common shares for upside. I think it should be said that what we're talking about here are option strategies. It's not about whether or not.
Yeah, this has nothing to do with the
equity
common
markets.
stock. Common stock could be a great buy, great sell. This is independent and separate.
Yeah, this is just an independent strategy. I think we've talked about gold already, which is unsurprisingly on many people's minds. I think, Carter, it would be safe to say that your view is that it is extended by your work. There have been circumstances where it got more extended, but those are very rare.
Right, so you can act on the increment. You reduce. I mean, here, there's some proof by contradiction. One say, well, I don't want to sell I shouldn't sell. Well, then how about double it? Double your position. I mean, okay, so if it's going to be 79, you're going to make a fortune. But there's nothing wrong with acting in increments. That's what selling calls on a third of your position, or trimming 10% and selling calls on a third, or selling calls on all of it, or a risk reversal. I mean, you don't have to just be in or out, yes or no, good or bad. It's not quite as black and white as that. The great judgments are nuanced judgments.
The interesting thing, of course, is that if anybody is in the trade, if you were fortunate enough to have added it a year ago, if you bought GLD, for example, a year ago, it actually traded last November below 240. It traded down to 236 and change, and it's now trading almost 388.
Right.
So simply by virtue of time and appreciation, if you have a position in it, unless the rest of your performance in every other thing you've bought has been exceptional, way outperforming the market, your allocation to gold as a percentage of your assets has almost certainly increased by a material amount. So the question people might ask themselves, if you have it, and why they are not perhaps reducing it somewhat, is, do I want this to continue to grow to an outsized position even as it gets increasingly extended? I think that's a worthwhile question that any reasonable portfolio manager would ask. That's what a prudent man would do. Is this really wise for me to be having such an outsized position? It's one of the reasons why risk balanced portfolio strategies and portfolio weighting strategies, which is why portfolio managers, people often criticize them. They say, well, they often don't outperform the S&P. But if you take a look at a trust or endowment, it's true they don't often outperform the S&P. They also don't have the drawdowns of the S&P. And this is because if and as their better ideas appreciate significantly, they often will pair those trades and rebalance to the other things that they wanted to be invested in. And that very act will tend to mute the volatility of their portfolio. So it's something to think about. And everybody who's watching, who's listened to me for any length of time over the last couple of years, knows that I was a big proponent of gold. It was part of my best ideas for this year, for last year, and the year before. So, but I will say that this is, it's taking on more of a hockey stick-like shape, and that's why I was so glad to have Carter here to talk about that. Yeah. I think so. There's a couple things I wanted to say one other thing. So for the people who don't know, I encourage you to go to Worth Charting, his website. Even if you don't sign up for Carter's service, there's a lot of valuable information there that just you have the cave drawings. I think those
we have teach-in videos, really in-depth teach-in, as that's the sell-side expression when a new analyst is hired on covering railroads or covering software. All the sales community and others get into a room, and the analyst opens coverage. These are their buys, these are sells, and does a teach-in of what their approach and methodology is. And so there are teach-in videos that do talk about why the 150 average, the importance of volume, why certain levels are great inflection points to bet on, and so forth.
So I encourage people to go there. And with respect to the fund that that's sort of in the latter stages of planning, the best I can say is stay tuned, because I'm sure Carter will be making some announcements in due course. Certainly once, if and as the filings take place, then of course that's going to be on the public record, but we'll be sure to come back and talk a little bit more about it. But I think it's really critical for people to understand the underpinning investment philosophy that's associated with that. One final thing, I just happened to look at this when you were talking about insurance, and you were talking about Warren Buffett, and we were talking about Berkshire, and I just wanted to allow people to see my screen here for a second, because what I think is interesting when we talk about things that are extended and timing, you mentioned, that he doesn't think at all about timing. Well, at this moment in time, Berkshire Hathaway is almost 50% in cash. Right. Which I think is rather interesting.
Timing.
That by its definition, that's timing. He's generating massive amounts of insurance premiums. He has a huge amount of it, almost $500 billion. He's almost to $500 billion of investable cash. And he's not investing it. Why not? I think we could probably end on that. Just allow people to noodle on that a little bit and then decide whether or not there are better times and worse times to enter and exit securities. Carter, it's really been great having you here and talking to you about this, and I look forward to having you back.
Excellent. Thank you so much.
Take care, everybody. We'll see you next time.